a tool called Arrow Workflow to help us delegate all of the different activities we had to do, all the different tasks we had to do for different clients and at different intervals and different staff doing different things. So Arrow is used by accounting firms to manage generally staff in different places, but even if you're all in the same office, even if you're just one person, accounting firms, solopreneurs use it to help distribute their knowledge and how they do things in their business to everyone who's going to do it, so that your firm as a whole operates and performs their work consistently. And there's an Arrow library that has lots of checklists of a lot of this kind of work that we all do in common in QuickBooks Online, working with bank feed, reconciling books, stuff like that. And the third thing I spend a lot of time doing is I'm a member of Intuit's Trainer Writer Network. So I do webinars like this. I also co-authored a lot of Intuit's QuickBooks Online certification courses over the years, and I've traveled around the country teaching QuickBooks Online. Maybe I have met you before teaching QuickBooks Online or at some of the National Accounting Technology conferences. I love those. I miss those. We'll get back to those soon. Okay, next, let's talk real quick about CPE. This webinar is eligible for CPE. You want to make sure that you attend the webinar, respond to the checkpoints that are going to come across, and answer the polling question. And then they will email your CPE certificate to you at the email address that you use to register for this webinar. Here's our agenda today. Very basic as far as the structure of it goes. We're going to get into KPIs, a little introduction, and then we're going to talk about financial statements, financial ratios, and then a couple other metrics at the end. And these are our learning objectives for the webinar today. We're going to talk about the role of KPIs in advisory work. We're going to talk about a lot of common KPIs. So if you're just getting into this work of doing KPIs, then we're going to just give you some of the basics to start with so you can just be off and running with that and how to calculate them. Advisors like yourselves use data, right? And we use this data to help businesses analyze and develop insights to support their clients' organizations in the decision-making process and in being successful. So they're important to us, but let's back it up a minute. You might be wondering, if you're new to this, what is a KPI? Let's start there. The letters KPI stand for Key Performance Indicator. And they're what you use to tell you how a business is performing. They're derived from analyzing the financial information of a business. And we're going to go through and do that together today so you see what I mean. Because you do all of this work, entering, recording activity, you or someone does all the work recording all the financial activity that happens in the business. You get these reports at the end of the month. And it's very easy for business owners to not read them or know how to read them or what do you do with them? How do you make them meaningful? So KPIs are calculations that assess the performance of the business against a specific target. So yes, a KPI is a metric because it measures a value at a specific point in time to see how you're doing, but it's more than a metric because it involves strategic goals and objectives so that you can assess their performance against a specific target. So it's more than just how am I doing? It's more like, am I on target for how I'm supposed to be doing, for how I wanted to be doing? The role of the advisor, our job, is to help the business analyze its goals, and then to help the business, your client, set targets that are in line with these goals, and then to define the KPIs that will help the business monitor whether they're in alignment with those targets or those goals. So the advisor's job is going to be to regularly analyze performance and to regularly evaluate whether your client is successful at reaching their targets, and to regularly provide insights from the results of the KPIs so that the business can make decisions that are based on the knowledge of where they stand right now and where they want to go. Have any of you seen the TV show called The Profit, hosted by Marcus Lemonis? That's a fun show. I've watched I've binged on a few of those shows. He's a successful businessman and philanthropist. So if you've seen that show, then you probably will have heard him say that regardless of the size of the company, every business owner needs to know 3 numbers: annual sales revenue, gross profit margin, and expenses as a percentage of gross profit. And these are KPIs that can help a business plan for success. Now, this webinar is not about the show The Profit. I just bring it up because it's a popular show and some of you may have seen it. And I want you to recognize that those things he's talking about all the time are KPIs. And he's using them to help those businesses be successful. We advisors use tools. Of course we do. We can't do it all in our head. We use tools to help us analyze the financial information that's coming from our clients. QuickBooks Online is certainly one of those tools. It has its performance center. Here's a screenshot of that, which includes some pre-built charts. We've got revenue charts and cash flow charts, and you can further customize and add additional charts. There are expense charts, cost of goods sold, gross profit, net profit. So this work we do, the work of KPI advisory, is very valuable to businesses. I want you to hear that. It requires skills and knowledge in order to provide that insight into how the company's doing. And the purpose of it is to advise the company leadership, your client's leadership, executive leadership team, on what they need to do so that they can be successful. And that's very valuable. Now, the role of the advisor requires that you understand how to read financial statements. So this next section, we're going to start taking a look at that. We kind of have a broad sense now of what KPIs are and how they're going to be used and how valuable they are. So let's take a look at starting to work with them. As all of you accounting professionals know, financial statements are where you find important information about the business. It's the results of all the financial activity that's been made. And as pro advisors, you're probably familiar with QuickBooks Online's Report Center. And the 2 main financial statements that you'll find there are the balance sheet, which we know shows the total sum of assets, liabilities, and equity at a certain point in time, and the profit and loss statement, where you'll find income, costs, expenses, and profit for a given period of time. Now, QuickBooks uses certain default terms on these reports for each section of the report, but you can change those now. That came out a couple of years ago. You'll see a little hyperlink that says edit section titles up in the header of the reports. So if, for example, you wanted to rename the equity section on the balance sheet or the net income section on the P&L, you can do that now if that needs to be customized for the particular business you're working with. Okay, here we have a P&L. Now, income is the term that QuickBooks uses by default to mean sales or revenue or gross receipts. That's all the money that came in for selling the product or service that the company sells. And sales growth is one of the most basic barometers of success. Many businesses watch this number or they'll watch a trailing 12-month period to gauge how their annual sales revenue looking. Businesses also watch expenditures, both direct costs, which we call cost of goods sold on QuickBooks Online's P&L report, and the expenditures that a business incurs to provide their product or service. The cost of goods sold is the direct expense. When you purchase the material for the product you're selling, that's a cost of goods sold or a direct cost. Then we also have indirect expenses, which are all the other expenditures that are involved in operating the business. They may not be things that you're selling as your product or service, but they'll be things like rent, marketing expenses, things like that. Now, one quick and important metric that we can calculate on the P&L, which is calculated for you, is the gross profit. So you take the income and subtract the direct costs, and that's the gross profit. And then you can go further and subtract those indirect expenses, which we call overheads also, and then you end up with the net operating income. So those are important calculations for you to do just by looking at the P&L. Now, let's stop right here on the P&L. We looked at the income, we looked at the cost of goods sold, and we measured gross profit by using those two numbers. Then we looked at the expenses or overheads, and we then calculated the net operating income. Now, there are some other expenditures, and if we don't subtract them, if we don't include them with overheads, and they are, I'll call them out, interest expense, taxes, depreciation, or amortization. If we just look at the profit before subtracting those four expenses, interest, tax, depreciation, amortization, then you've got an important calculation that's called Ebitda. And you'll hear people talk about Ebitda, and that's how you calculate it. And so one way to make that easy is, if it's possible with your clients, if you can record or organize your chart of accounts such that interest expense, taxes, depreciation, amortization are down in the other expenses on the chart of accounts, then they'll fall in the P&L report. They'll fall below the net operating income line. So you see I have an arrow pointing at the net operating income line. Imagine if interest, tax, depreciation, or amortization fell below that in the other expenses section, then your net operating income could be the same as your Ebitda, and then you won't have to manually calculate it. You can just have it here on the P&L. And some people, for whatever reason, can't do that, and their interest expense, tax, depreciation, amortization may be up in the regular expenses area, in which case you can just run a P&L and then back those numbers out. But anyway, look and listen for Ebitda, know how to calculate that, and it stands for earnings before interest, tax, depreciation, amortization. It measures the profitability of the company without the influence of accounting deductions. So if the business has organized its chart of accounts with interest, tax, depreciation, amortization as other expenses, then that net operating income line will be your Ebitda. So Ebitda is used to manage spending and to determine the earnings potential of the company. And we're going to see it come up in a little bit when we talk about some ratios, because it's one of the factors that we'll use in some ratios. Now let's talk about some other ways. Now, with that conversation on Ebitda, we talked about how to organize the chart of accounts if you wanted to just get your P&L to also show Ebitda. Let's talk about some other things related to classifications. In addition to your chart of accounts, many organizations track financial activity by products and services, locations, classes, and customers. So you can customize your P&L to show columns by these categories that may help you track your revenue, costs, and expenses and margins for each of those. So in this sample that I have on the screen, we can see that this company is recording activity, and when they record revenue and expenditures, not only do they assign the chart of account revenue or expense account, but they are also tagging it in another field with a certain class. And this company is using that class tracking so they can run a P&L report, and instead of one column by total, you can say on the report, you can change it to show columns by classes. And that lets you see side by side which of your classes has which revenue, which dollar amounts for revenue, which class is performing better for revenue, which classes are the most profitable, which classes have the highest expenses, things like that. And that's really nice to see. People use classes for all sorts of different things. If you really want to learn a bunch about classes, and especially class tracking versus location tracking, the QBO Advanced Certification has a great section on that and explains how they're similar and how they're different. So now let's jump to the balance sheet and talk about it for a little bit. Right here on the balance sheet, we see we've got our assets and then our liabilities and equity. And one quick and important metric that we can calculate on the balance sheet is the working capital of the business. And so to do that, you take the current assets and subtract the current liabilities. And the working capital is the amount left over after the company pays off its current debt. That's how you think about it. So positive working capital means that the company can fund its operations and or invest in its future. The company has enough cash to meet its current liabilities. It's the business's cushion or margin of protection. Okay, time for a polling question. We would love to hear who you are. So tell us, what is your role in your profession? Are you a CPA or accountant? Are you a bookkeeper? Maybe you're an accounting teacher or student. Or maybe you're the small business owner or employee of a small business. Or other. If you didn't fit into one of those categories, that's perfectly fine. You can check other. Okay, I'll give everyone a little bit more time. This one should probably be pretty quick and easy for most everyone. All right, thank you so much for that information. We'll show the results on screen for everybody who's interested to see who's listening today. Okay, now that we've looked at some financial statements and kind of reviewed the different sections of balance sheets and P&Ls, let's get into financial ratios and how to use that information from the financial statements, like the balance sheet and the P&L, how to calculate the financial ratios. So financial ratios are, I think of them as comparisons of values from financial statements, usually from financial statements. The ones we're going to do today are from financial statements. Advisors like yourselves can compare amounts to each other. I think of that as the most basic way. Like if you picture a ratio, you'll sometimes see it written as a number and then a colon sign and then another number. And those are really comparing themselves to each other. So it helps you shed light on the health and performance of the business. These comparisons will identify strengths and weaknesses. The result of the ratio will then help you offer suggestions for improvement. Financial ratios are used by banks, investors, advisors, owners, the management of the company. So as we go through these, see if that hits home as we look at these today. See if it hits home for you that one way to think of them is that you're comparing two numbers. And you'll do that by dividing them to get a result that you can then use to offer suggestions. Also, as we look through and discuss the financial ratios today, I'll be using these symbols. These are not symbols used anywhere else. They're just ones I kind of picked off to use for the purposes of this webinar. So you don't have to memorize these, but as we go through each ratio, I just wanted an easy way to be able to make sure we kind of touch on these three components of a ratio. On each of the ratios we're going to talk about, we'll show what the formula is, so you'll know how to calculate it. We'll talk about what a standard target might be for that business, what they might want to aim for, and what actions you can take to improve upon the ratio. Now, not all ratios will be important to clients. The KPIs that help that business that we're going to go over in today's webinar are a great place to start. You can see that I have on screen here, there are four main categories. There are liquidity ratios, solvency ratios, efficiency ratios, and profitability ratios. And we're going to go the assets that are most easily converted to cash, or they're to pay off every $1 of current liability. If that ratio is too high, it could signify that you have too much inventory, or that you have, I don't want to say too much cash, but too much cash that you could be investing. There is such a liquidity ratio is too low. It indicates that a company is overburdened with debt and at risk of defaulting. Here's my puppy dog. So let's start in on some example liquidity ratios. The first one is the current ratio, and these are really common ratios. So if you don't know them or haven't heard them already, listen up, because you will hear them used. And so it's good to know them anyway. And there's certainly ones that you can use as great litmus tests. Kind of point out any warning signs you see. So the current ratio is our first one. It's calculated as current assets divided by current liabilities, right? So I'm going to go slower on this one just to kind of drive it home for anyone who's new to this. You look at your balance sheet, on the asset section, there's a subtotal of current assets. Take that number and then look down on your balance sheet to the liability section and just find the subtotal of current liabilities and divide current assets by current liabilities to get your current ratio. The current ratio measures the company's ability to pay off those current liabilities with those current assets. So it answers the question, do you have enough cash and accounts receivable to pay off your accounts payable? You want a minimum ratio of 1, better if it's 2, but if it's lower than 1, that indicates well-being. That is a good sign. If it's too high, it could indicate excess cash that's not being properly invested in the business. Maybe you could buy more assets that will create more profit. If the current ratio is below 1, there are several actions you can take to improve it. You could focus the business on earning cash and paying down the debt, reducing the debt. You could focus on selling unused fixed assets. You could reduce overhead spending. You could delay capital purchases, hold off on that. And or you could reduce equity distributions at this time, just to keep cash in the company's coffers. Now, the current ratio is very similar to the working capital measurement. Remember when we were talking about financial statements and we were looking at the balance sheet and we took the current assets minus current liabilities? The current ratio is just another way to compare those two same factors, right? You're still messing around with current assets and current liabilities, but you're dividing it instead. And so the current ratio is also commonly known as the working capital ratio. Now, you can see on the screen on these slides, I have several slides where I talk about the ratio that we're talking about. And then when we switch ratios, it shows in orange just to kind of call out that we've switched now. So we've switched now from the current ratio to the quick ratio. And the quick ratio is very similar to the current ratio. And it is calculated as current assets minus inventory divided by current liabilities. So everything is the same about the one before, the same as the one before, except we're going to take inventory out of the equation. And the quick ratio measures the company's ability to pay off their current liabilities with their current assets, not including inventory. The current assets involved in this ratio are assets that are more quickly converted to cash, and inventory does not convert to cash as quickly as other current assets do. And the other current assets that are typical, that are left in this calculation of current assets when you take out inventory, okay, on this quick ratio, same as the current ratio we talked about before, you would like to get a minimum ratio of 1, better if it's 2. If it's lower than 1, you may consider looking into how to convert inventory to cash. Also, you may hear this quick ratio referred to as the acid test ratio. And that's a quick ratio people will run on a business when they're looking for a good indication of the health of the business. All right, here's our third one, the cash ratio. See that in orange? The cash ratio is calculated as cash divided by current liabilities. So just like the other two, This ratio measures the company's ability to pay off short-term debt, but with cash and cash equivalents, which means money available on the bank accounts. So that takes us through some liquidity ratios, and where those liquidity ratios are focused on whether the company is able to pay short-term debt, short-term obligations. This next set of ratios are concerned with whether a company can meet its long-term liabilities or financial commitments. Solvency ratios evaluate the amount of capital or assets that comes from debt. So here's one way to look at a balance sheet. A company can finance its assets with either debt or equity, right? On a balance sheet, you've got all the assets, that's the total amount. That is going to equal the liabilities and equity added together. So the company has financed its assets by either taking on debt or by equity, which means contribution paid in by the equity ownership or retained earnings. So if the business has significantly more debt than equity, it's said to be highly leveraged and at a greater risk because it's probably having to deal with things like high interest rates and debt payment obligations and a limited ability to borrow additional funds. Whereas a solvent company owns more than it owes, right? Equity is higher than the liability. So a solvent company has a positive net worth and a debt load that it can manage. Now, in addition to calculating the solvency ratios that we're going to look at next coming up, you'll want to investigate what type of debt it is also. You've got credit card debt, and credit card debt will often have high interest rates attached to it, or you may have personal loans found in the liability section on the balance sheet. You want to make sure that these have formal loan agreements for them, and that they're abiding by those loan agreements. And you may see bank loans in the liability section of the balance sheet. And bank loans will have covenants, and they will have requirements and restrictions. For example, requirements to pay taxes, maintain certain financial ratios, maintain positive cash flow, maintain insurance coverage. So this is the type of information that the advisor, you should be aware of to help ensure that the business is complying with these covenants and requirements so that the bank won't call on a loan due immediately or something like that. And the advisor, and so these are the questions you can ask the business when you're working with it. And you won't know it all the first day. You don't have to worry about knowing everything the first minute you look at the company, but these are the types of things that you can start to inquire about when you're working with your clients. The advisor is going to help the business monitor that financial condition, the performance of it, to help them avoid being in a bad situation. Okay, let's get into some solvency ratios. First up, we've got the debt to equity ratio, and that is calculated as total liabilities divided by total equity, right? So we're taking it to the balance sheet. We're on the bottom half of the balance sheet. Grab total liabilities, not total current liabilities, but total liabilities divided by total equity. The debt to equity ratio measures the proportion of debt and equity being used to finance the company's assets. So remember, company can finance its assets with either debt or equity, and this ratio measures that. The debt to equity ratio measures the amount that creditors have put in the business for every dollar that the owners have put in. That's another really good way to think about it. For this ratio, the lower the better. Remember the liquidity ratios, we were looking for the higher the better. Now we're looking for the lower the better. The higher this ratio gets, the greater the degree of leverage and financial risk. Banks may not loan money if a business has a debt to equity ratio of over, say, 2. Now, this varies by industry. You'll want to get more detailed information about the business that you're working with, if there's a special case there. But if you want to just use standard, you could start with 2, wanting to stay below 2. A business with a higher debt to equity ratio can do some things to help. And here's a list of them. The business could really focus to generate profits and use those profits to reduce their liability, pay down their debt. Or they could focus on downsizing the business's overheads, reducing those indirect expenses in order to increase profit to then reduce their liabilities. They can refinance their debt, see if that's an option for the business. They could sell assets to help pay down the debt. They could sell stock to increase equity. These are the types of suggestions that you can have great discussions with your client about. The debt to equity ratio is also known as the risk ratio. You'll hear that name used. Okay, so now we're on a new one. The debt to Ebitda. This is another solvency ratio, and it is calculated by dividing total liabilities by earnings, and not just any earnings on the P&L, but Ebitda. So for this one, get this image in your head, go to the balance sheet, total liabilities, total all liabilities, not just current or long-term, all total liabilities divided by, then go to your P&L, and if you've classified your interest, tax, depreciation, amortization as below that line, find the amount, you may have to manually calculate it, but find the amount that shows your net operating profit before interest, tax, depreciation, amortization. So find your Ebitda. And this ratio measures the portion of debt that is owed to the creditors in relation to earnings. Now, again, just like the debt to equity ratio that we looked at right before it, the lower the debt in relation to earnings, the better. A high ratio can indicate that a company could be slow in paying off its debt. So to lower this ratio, you could focus on increasing earnings and reducing liabilities. Okay, our next ratio is another solvency ratio, and it is called the debt service coverage ratio. And this measures the amount of cash flow available to pay the debt, the obligations. Now, debt service coverage is calculated as the net operating income divided by the total debt service. And total debt service is the current debt that's due in the coming year, right? So on your balance sheet, look for the current liabilities section. And if you have long-term liabilities, see how much of that is due in the coming year. Lots of people journal that next 12 months up into the current liability section. So that's your total debt service. All right, so net operating income divided by total debt service. And here's my note about that. On the balance sheet, this includes the short-term debt and the current portion of long-term debt. In this case, the higher the income in relation to debt, the better. If this is too low, you could concentrate on attempts to increase earnings or reduce current liabilities and the current portion of long-term liabilities. Pay those down. Look for ways to do that. And so that's where you get into conversations with your clients. These suggestions are meant to trigger conversations with your client. Okay, now we are in our third category of ratios, efficiency ratios. These examine assets and they measure how well the company is using its assets, how efficient the company is at using its assets. And managing cash as an asset is particularly important. Paying bills too quickly or collecting payment from customers too slowly can drain the bank accounts. So we want to manage our assets very efficiently. We're going to start here with a common efficiency ratio called the asset turnover ratio. And it is calculated as the total income divided by total assets. So go to your P&L, grab total income, total revenue, total sales, whatever you call it, and then go to your balance sheet, grab total assets, and divide total income divided by total assets. The asset turnover ratio measures a company's ability to generate sales from assets. And that's a way to look at how well the company's doing that. The asset turnover ratio is also known as the income to assets ratio, and it answers the question, are the assets contributing to the profitability of the company? Because they should be. And with this ratio, the higher the better. A ratio of 2 means that there are $2 in income for every dollar in assets. A company with a high ratio operates more efficiently than one with a low ratio. A low ratio indicates that the assets are not providing adequate revenue. To improve this ratio, sit down with your client and have some discussions about increasing revenue or accelerating AR collections. And as you have these conversations on all of these ratios, think about the two factors in the calculation you're making. So in this case, when you're talking about increasing revenue, using the assets to do that, accelerating AR collections, bring that cash in, reducing excess or obsolete inventory, discussions about maybe liquidating unused assets. The receivables turnover ratio is our next ratio, and it is calculated as taking credit sales divided by accounts receivable. The receivable turnover ratio measures how many times a company can turn their receivables into cash in a given period. So let's say if the ratio is 15, that means that on average, your accounts receivable turns over 15 times a year. So the higher this ratio is, the better. Now, I mentioned that this ratio is calculated by taking credit sales divided by accounts receivable. Let me just go back a second and talk about that. When you look at your P&L, you see total sales. It may be that the company has recorded its revenue by transactions, by invoice transactions. So the credits in the revenue section may all be attributed to debits and accounts receivable. In that case, all of the revenue is going to be credit sales. But if the business also has cash sales, like some things that sells by sending invoices to collect later and some things that sells at a cash register, then you'll want to identify just the part of the revenue that comes from invoiced sales that are going to be collectively, or where the debit goes to accounts receivable. So take the sales that are credit sales and divide it by accounts receivable. Okay. So for this ratio, the higher the better. And high ratio indicates a good credit policy. Now, a low turnover ratio would indicate potential collection problems. So if you have excessive receivables, that's going to weaken the liquidity of your accounts receivable, and it could lead to future losses if you have to write it off. So there are lots of things you can do to increase a receivables turnover ratio. First of all, you could shorten the AR credit term. Instead of giving everyone 30 days, maybe it's shorter. Or instead of giving everyone 90 days, maybe it's 30 days. You could send the customers monthly AR statements, just as a way to say, here's the list of the outstanding invoices in case they didn't receive an invoice and weren't aware of it. You could make it easier to pay the company. QuickBooks Online has amazing tools, the online invoices, and then if you turn on QB Payments, Merchant Services, you can email an invoice, you can see when the customer opens it, and they can click to pay. They can also do auto pay. Anyway, make it easy for customers to pay invoices. You could request purchase orders on the front end so that when you do send an invoice, you're referencing the purchase order, which shows the accounts payable department who's going to pay your invoice that this is already an authorized purchase. You could issue engagement letters which agree on terms, and then you could do some collection efforts, even if you just do the basics. The basics would involve confirming that the invoice was received, and these are just easy conversations the business can have with their customers, without getting into uncomfortable situations. Just ask them if they've received the invoice. Then ask them if it's authorized to pay. Do they have any questions about the charges on the invoice? It kind of just gets it moving along instead of just doing nothing and hoping they pay one of these months. And then once they say it's approved to pay, then you can just ask them what the expected pay date is. So just those conversations on some light collections efforts can help a lot. Okay, our next KPI gives you the number of days on average that it takes for customers to pay your invoices. So for this KPI, you're going to take the number 365 because that's how many days are in a year, and you're going to divide it by that receivables turnover ratio that we just calculated in the ratio right before, which is credit sales divided by AR, remember? So let's just say the ratio is 25. That means that on average, your AR, or the business's AR, your client business's AR, is collected every 25 days. So of course, the lower the better. The faster you collect the money, the better. You could research the industry for that business and see if there's a benchmark for AR days, so you know what a good target should be. And there are tools that you can use for benchmarking, like LivePlan or SageWorks, ProfitSense. You can Google it. Your businesses that you work with may be involved in their own industry or their own professions. Membership groups and journals, they might have that information already, so you can ask all good conversations to have with your client. Ask the client. Okay, so that was AR. Again, these efficiency ratios are looking at how efficiently our assets are working for us. So next, we're going to turn our attention to inventory. The inventory turnover ratio is calculated as cost of goods sold over on the P&L divided by inventory over on the balance sheet in the asset section. So the inventory turnover ratio measures how many times a company's inventory is sold and replaced in a given period. So let's say if the ratio is 10, that means that the inventory turns over 10 times a year. The higher this ratio is, the better. You create a business to sell that product. You don't create the business, I'm saying something obvious here, to just hold on to the inventory. That's not going to create much profit for you. So you want to turn that inventory over. That means things are moving. Things are hopefully being sold, not just written off. So the higher this ratio, the better. A high inventory ratio indicates good inventory management, whereas a low inventory turnover ratio indicates excess inventory on hand. And excess inventory on hand can cause insufficient liquidity and also incur inventory holding costs. So if you have this situation, there are some actions you can focus on to increase the inventory turnover ratio. You can calculate what the appropriate inventory levels should be, how much you need based on the expected sales, and then reduce inventory to that amount. A common issue businesses have is they just bulk up on all this inventory and they're not going to sell it for a while. So have some good discussions with your client about how to manage their inventory levels. And then also, you can also have discussions with your client about how to promote some of the items. Like if you have best-selling items, the ones that do turn over and they're high margin, focus on those. Get those best sellers moving. If you have items that customers want to buy, stock those. If you have slow moving inventory or obsolete inventory, mark those down maybe, or bundle them with something else. Help eliminate those slow moving items. And some businesses will implement a just-in-time inventory strategy so that they're purchasing the material or their inventory just in time to sell it as a way to decrease waste and just focus on receiving the goods only as they're needed. Okay, our next ratio, we're going to do the same that we did with AR. Now we're going to look at the days in inventory ratio, and we're going to divide 365 days a year by that inventory turnover ratio we just calculated. And this gives you the number of days on average that it takes for inventory to be sold. Let's say the ratio is 90. That means on average, inventory is turned over every 90 days. So the lower the better. The KPI, this KPI indicates how well the inventory is being managed. A high ratio indicates that the inventory sits on the shelf longer than is ideal. So that's a good one that'll prompt some good discussions with your client about how to use those assets most efficiently. Okay, here we are at our fourth category of ratios. We've done liquidity, solvency, efficiency ratios, and now we're moving on to profitability ratios. And we're going to kind of move over to the P&L. The profitability ratios measure a company's ability to generate income and profit relative to expenditures and relative to asset and equity. Remember that a P&L report, which we looked at at the beginning, shows income minus cost of goods sold equals gross profit. So gross profit is a monetary value, right? If you made $10 minus $5 of cost of goods sold, you have a gross profit of $5. $5 is a monetary value, $5. But when you add the word margin to it, now we're talking about a ratio, a percentage value. So the gross profit margin is just taking the gross profit, the monetary value, and dividing it by total income. So that is how we're going to look at, and those margins help you get away from exactly what the number is and start to look at what percentages are meaningful to the business. Okay, so the gross profit margin compares the gross profit of a company to its sales. See, let's talk about ratios, how a lot of times you can just think of ratios as comparing different segments of the profit and loss to the profit and loss, or the profit and loss to the balance sheet, different areas. Comparing them together is going to bring a lot of insight for you and a lot of suggestions and a lot of great conversations with your clients. See how much fun it is to finish, close the books and look at the results and do things with it. So in the case of the gross profit margin ratio, the higher the better. You probably knew that one. If the gross profit margin is, let's say, 60%, then that means that for every dollar in sales, there's 60 cents in gross profit. Now, you want to compare this to the industry benchmark for the typical margin for your client's business, because certain types of retailers, like discount retailers, will often have a very low gross profit margin, but really high volume sales, right? Like dollar stores. But then you have specialty boutique stores that might have a really high markup and therefore a higher gross profit margin, but they might have a low volume of sales. So you take all of that into account and find the ratios that are the most helpful for your business, your client's business. So if you want to improve a gross profit margin, you could consider price increase on the things you're selling. You could eliminate or reduce discounts to customers. You could find ways to reduce the cost of goods sold, the production cost of the thing you're selling. You could look for ways, explore ways to reduce waste. Look into whether there is any spoilage happening if you're selling items with a shelf life. Look whether employees are consuming the things that you're selling, because those are not going to make any money if they're not paying for them. Look for theft. You can also look at your suppliers who you're purchasing your supplies from, the things that you're selling, and look at whether they offer any discounts, and maybe renegotiate costs with your suppliers or find suppliers with lower prices. All of those are going to affect your gross profit margin. Also on a P&L report is a line called operating profit. Now in QuickBooks, this row is named net operating income by default, and it's the row just under total expenses. We looked at it first part of this webinar at the top of the hour. And it calculates the revenue minus cost of goods sold minus expenses. And this ratio, the operating profit margin ratio, is where you take that net operating income line from your QBO P&L and divide it by sales, or total income. And in this case also, the higher the better. A low operating margin is caused by, this will sound obvious if you think about the factors involved in calculating it, it's caused by a low gross margin, which we just discussed, which is related to sales and cost of goods sold, or too high overhead. So to reduce overheads, you could do any of the work that we just discussed when we talked about the gross margin, if you have a low gross margin. But if you want to focus on overheads, you could reduce overheads, renegotiate with vendors for your operating expenses. Maybe you move or renegotiate your rent. You could look for any inefficiencies that are costing money. Perhaps you're too overstaffed and your labor is too high. Maybe you're being charged huge bank fees for something you didn't even realize. Look at your job materials, supplies, tools, see if any are wasteful or any are being stolen, look for theft, certainly. You can lower other expenses, like other overheads, like phone, internet expense, insurance, any other discretionary spending. Just look into them and see if there's any place where you could reduce those overheads so that you can improve the operating profit margin. Okay, and our next one on the P&L is the net profit margin ratio. So the net profit is the bottom line of the P&L, and it's called net income when you look at QBO's P&L. And it's the total income minus cost of goods sold minus expenses plus other income minus other expenses equals your net income. And so to calculate this net profit margin, you're going to take the net profit or the bottom line on the QBO P&L and divide it by total sales. So in this case, also the higher the better. The net profit margin needs to be sufficient to cover the owner's draws and personal income taxes, for sole proprietors, for partners, for S corps. Now, to improve the net profit margin, you could focus on or have discussions with your client about improving the operating profit margin, which we just went over on the ratio before, and then looking into the other expenses, such as perhaps there's really high interest expense there, and maybe refinancing the debt would lower that interest expense. So drill into your other expenses and see what you find there. Okay, let's also talk about these are a little more general, some spending ratios. So these are kind of picking into the P&L, kind of picking out some particular areas of expenditures that are quite common. So spending ratios are going to measure how wisely or how efficiently the company is spending on some of the major overheads. And those are rent, those are often rent, payroll, and marketing. Now, your client's business may have other ones and that are particularly high, R&D or whatever it is, and you can go in and run these same ratios, but just use that expenditure instead. But just being very general, we're just going to look at some common ones. Rent, payroll, and marketing are usually significant expenditures on a P&L. So spending ratios are calculated by taking that expense, rent, payroll, marketing, whatever it is, and divide it by total income. It's best to compare your company's spending ratios to others in the same industry or region, because if you just compare it to everybody else in the world, these can be very different for different types of businesses. So compare them, look for benchmarks within your client's business, industry, or profession. Now, when you're calculating the amount of revenue spent on rent, a low ratio could mean low rent. Good job. Or it could mean a high rent that successfully brings in high sales. So you do still want to look at the numbers that are driving the ratio to determine which it is. Is there a problem, or are things as you want them? For marketing, if you spend less money on advertising and promotions and still generate the same revenue, that's great. That's more profitable. But you need to make sure that you spend enough on marketing to make sure that there's not a ripple effect down the line. You want to make sure that the customers remember you and that your competition isn't making a bigger splash. You don't want to just cut marketing and say, woohoo, we've got more profit now, and then cause sales to drop off in the coming months. So drill into the numbers that are causing, that are components of the calculation that give you the KPI. Okay, here's our next ratio, the expenses to gross profit ratio. And this is one that Marcus Lemonis mentioned as one to watch, that a lot of businesses don't always think to watch this one. So this one is calculated as total expenses divided by gross profit, not divided by total sales. Normally people will divide things on the P&L by total sales. What percent of total sales is this? But in this case, we're going to divide total expenses by gross profit. Expenses to gross profit measures how well the company is spending its gross profit. So the lower this ratio, the better. And the point behind dividing it by gross profit is that your bills are paid, your indirect expenses, I should say, your overheads, are paid with gross profit, not with revenue, right? You bring in revenue, you have to pay your suppliers so that you can keep purchasing the product or service that you're then selling. And the money that's left over, the gross profit, is what you have to spend on overhead. So watching the ratio this way watching this ratio will make you more conscientious of spending. So let's take an example just to kind of see it. Let's say that revenue is $10,000, cost of goods sold is $5,000, so your gross profit is $5,000, right? Now, let's say you have operating expenses of $3,000. So your operating expenses at $3,000, if you compare it to total sales, which are $10,000, then your operating expenses are 30% of total sales. But if you look at your operating expenses of $3,000 and compare them to your gross profit of $5,000, your operating expenses are 60% of gross profit. And that really will stand out and kind of drive it home more to your clients. So you could run both numbers and just kind of talk it out. It's just something to talk about when you're meeting with clients. So to improve this ratio, obviously you want to aim at decreasing expenses or increasing gross profit. Next, we're going to look at the return on assets ratio. That is going to compare profit, net income to assets. And it measures how efficiently a company is using its assets to generate profit. So return on assets, you'll hear people talk about that a lot. That's calculated by taking the net income from the P&L and divide it by total assets. The higher the ratio, the better. If the ratio is 3%, that means there's 3 cents of profit for every dollar in assets. So the ratio tells you whether the leadership is productive in using its resources. So to improve this ratio, you can look at increasing sales, reducing expenses, reducing AR, reducing inventory, selling unnecessary assets. All of these we're starting to see come up again in different ways. So these are all common themes and discussions you can have with your client. Our next one is return on investment. Similar to return on assets, the return on investment ratio compares the profit to the equity. So it measures how efficiently the company is generating profit by using, instead of assets, by using the shareholders' investment. So the return on assets ratio, the return on investment ratio, this one, is calculated as net income divided by equity. And here, the higher the better. So if the ratio says 1%, that means you have a penny of profit for every dollar that the equity investors, the owners, put in the business. This ratio shows that the company can reinvest its earnings wisely to increase profits. And some things you can do to improve this ratio are to focus on increasing sales, reduce expenses, expand operations, or even buy back equity from investors. Okay, guys, here's our next poll. Which ratio, see how, I'm going to test you on this. Which ratio measures a company's ability to meet its short-term obligations? And it should be a minimum of 1, signifying that there is at least $1 in current assets to pay off every dollar of current liability. Who remembers this? This is in the first category of ratios we looked at. Who remembers this one? In those ratios, we were just on the balance sheet, we were comparing assets to liabilities. Okay, we're going to see what everyone's answer was, and if you guessed current ratio, then you were right. Good job. Okay, so just to finish up here before we go, there are the standard financial ratios that we talked about. There may be industry-specific ratios. There can be department-specific ratios to analyze and track. So there are other metrics outside of the financial statements. And to measure those, you can use software tools. The business will use other software tools that are available to help calculate and watch those metrics, like dashboards. And you can use a dashboard as a deliverable for your advisory service. So just to kind of call out some examples, like a restaurant may want to analyze sales per square foot. Now, sales is on the financial reports, but square footage isn't, right? Or a restaurant may want to analyze how many customers come in a day, or table turnover. So there are things certainly outside of financial statements that businesses will want to and should track. An HR department, right? Now we're not talking about an industry, we're just talking about a department of a business. An HR department may want to track things not on financial statements, like revenue per employee to measure productivity, or employee satisfaction index, salary competitiveness ratio. So lots of things to measure, always lots of things to measure. Find the ones that are meaningful for your client. A manufacturer may want to track order fulfillment, cycle timing, yield, lots of things, lots of different tools available to help track that. Here's a marketing department. I'm just showing you lots of ideas and dashboards here. Marketing departments, are going to track things like open and click rates on email campaigns, customer satisfaction index or net promoter score, social networking footprint, customer lifetime value, customer acquisition cost, rate of closes won on proposals, how many proposals went out a month, net recurring revenue per month, lots of stuff to track. So you as the advisor can help the company's leadership team by assembling the most important KPIs from your dashboards. There may be lots of dashboards, and your calculations, and put it all into a scorecard for your work with them, and to help align those KPIs to the company's goals. So here's just a screenshot of a scorecard. Each row is a different KPI that's being tracked. Notice that one column says measurable, the next column over has the goal. So all of the KPIs you're tracking are in line with the goal. And then to the right side, you see a column for each week or month or however frequently you want to watch it, so that the company, the leadership team, can see their progress and notice trends over time. So as the advisor, you're keeping the CEO or the executive leadership team in the know by reviewing and discussing financial statements and KPIs with them regularly, reading the balance sheet and the P&L together, discussing why revenue is down, but profits are up, or why profits are up, the cash is down, or if the business is too asset heavy. You can ask them questions. You can read the P&L balance sheet together and ask them what's happening in the business that might be causing this. And you can sometimes identify significant financial consequences before they occur, and help the business avoid surprises. And of course, suggest ideas. We talked about today, lots of ideas you can suggest that might mitigate risk. Ask them questions, listen to their answers. Okay, in conclusion, thanks so much for joining me today. We've learned several things about key performance indicators, how to calculate them, how to identify common ones, how to understand the drivers of common KPIs. So I want to thank you so much for joining me today in this discussion of key performance indicators. Have a great day.